Welcome everyone. This is the Zoo Digital final results presentation for the year to March 19. A quick recap. We work in the home entertainment industry and we provide services to producers of TV series and feature films to enable them to take their products and deliver them all around the world. And that entails localization, so converting those programs into different languages through subtitling and dubbing, and also digital packaging. So that's to say, providing those materials in the right technical formats so they can be delivered through many different channels to market. And of course, these days, the streaming video on demand services, these so-called over-the-top services, are where there's this huge growth in the home entertainment industry and a transition away from those physical products of the past, DVD and Blu-ray, into a digital future. We work with some of the biggest names in the industry, big film studios in Hollywood, as well as major over-the-top service providers. What sets us apart is that we have taken from the outset an approach that means our solutions are tailor-made for the needs of this new OTT market. And we've done that through an investment that spans over 10 years in creating proprietary cloud computing platforms that enable us to deliver these services in a very efficient way. And what that means for our clients is that we're able to deliver projects more quickly, to a consistently high quality, and at a competitive price point compared with others who've operated in this area for some time. We gain scalability from our proposition by working with a large global network of freelance workers who provide the linguistic services, that's translation and voice acting, and some other functions that enable us to scale our business and to flex our business in line with the demands that we receive from orders from our clients. To cover some of the highlights of the year we've just completed, the first point is that we've made some fantastic progress on our technology platforms through our continued R&D program, and I'll return to that point in a moment. But those investments ensure that we are very well placed to be able to capitalize on what we see as some significant growth opportunities that lie ahead. During the period, this over-the-top market has actually been subject to some disruption, and in fact, during the course of the year, we were impacted by disruption with a large client who changed the way in which they engage with vendors like us, as well as with licensors of entertainment content. And that led to a financial impact in the course of the year that we'll touch on a little bit later. This growth in OTT is continuing at pace now, and one of the consequences of that is that in the period we've also seen a faster decline than we'd previously expected in the DVD and Blu-ray market opportunity where we've been active for a number of years. So we saw actually a falling off of revenues that we generate through providing services specifically to prepare products for release on DVD and Blu-ray disc. Our ongoing investment program, as well as the R&D that I've mentioned, also extends to the people in our business. So we've hired additional people and we've trained folks over the course of the year in order that we are very well placed to capitalize on forthcoming growth. And that is in relation to some of these investments in new software platforms that, again, we'll cover in a little bit detail in a moment. Despite the disruption that we've been seeing in the past year in OTT, overall, in the medium to long term, we very much expect an ongoing growth in the market, and that given our unique position in that market, we think that Zoo has a great position to be able to capitalize on these forthcoming opportunities. And in that regard, at the moment, there are a number of major media companies who are going through a process, these so-called request for proposals processes, RFPs, in order to choose the major vendors of these kinds of services that they intend to work with during the period ahead. So the first thing is that we have been invited to participate in all of those RFPs, and whilst they have not yet concluded, we think that we're very well placed to be able to secure partnerships with at least one major player and possibly others too. I'd just like to take a moment to explain the way in which these large media companies procure the kinds of services that we provide. I've got a slide here that illustrates this sort of the process of vendor selection by a large buyers in the industry. I have to say that they all operate slightly differently, so I'm really kind of generalizing the overall approach, really just to make a few important points that I'd like to highlight. The first thing is that all of these large buyers will use multiple vendors to deliver these services. They will each be spending typically tens of millions of dollars annually in this area, and they de-risk their business by placing that work with multiple vendors. And those are vendors that they will select carefully, and they will put in place framework agreements and agreed rate cards, and they'll go through a cycle of that selection typically every 3 or 4 years. So if you are selected by a particular media company to provide these services, then you will become an approved vendor or a preferred vendor. Different companies call them by different names. But just to be clear, being a preferred vendor does not usually guarantee any volume of work. So typically what it means is that the majority of work that will be placed by that client will be divided amongst the preferred vendors. So we've been successful with our subtitling services of being selected as a preferred vendor with a number of major players, but typically we do not have any guarantees from those clients for this work. Of course, when going through this RFP process, the studios will invite certain companies to participate. And typically, over time, they will try out other potential vendors and new entrants in the market, and perhaps companies they've not worked with before, to assess their capability, to determine whether they can deliver work of the required quality, and the standards of quality that are expected in this industry now are very high, and also whether they have the capability of processing work in any significant volume. So when that happens, in this diagram, I'm calling that an ad hoc engagement. So our first experience of working with a new client is almost certainly of an ad hoc nature. So we'll persuade them that they should try us out, and they'll give us 1 or 2 projects to see how we get on. And if we do a good job of that, they may give us a little bit more work. But when it comes round to the next RFP cycle, we're then more likely to be invited to participate and provide a response that could lead to us being then selected. So our aim is always to be selected. When these processes happen, we always want to be one of the companies that is chosen in order that we can qualify for a significant proportion of the work that they will then place for the next 3 or 4 years. What I've also indicated on this chart is the final rightmost column. A number of these buyers will also have a notion of, amongst their preferred vendors, 1 or 2 perhaps primary vendors. So the work isn't necessarily divided equally amongst the preferred vendors. There may be 1 or 2 that are favored above all others. In that case, clearly, our intention is that when we are selected as a preferred vendor, that we will qualify to become a primary vendor. And that qualification, in part, also requires that we're able to demonstrate that we have the capacity to be able to deal with a large volume of work that they would then place. And some of the investments we've made over the course of the year that we'll return to shortly are in order to ensure that we're in that position and that we have that capacity and can demonstrate that capacity to our clients. The OTT revolution, if you like, has given rise to a really fundamental change in the way in which the home entertainment market operates, with this big shift away from physical products to digital distribution. We're on the verge of a new phase of development in this market through the launch of some new services that are about to appear from major media companies in the industry. But if we just look for the moment at the way in which the OTT market is operating today, it is led by what you might consider to be platform-first companies. Companies such as Amazon and Hulu, who've invested in creating a platform through which they can deliver services to consumers. And in the early days, those platforms have been populated through content that's been licensed from third parties, and typically large media production companies like Hollywood film studios. Over the course of the lifetime to date of OTT, of course, these major OTT platforms have also made considerable investments in creating their own original content and commissioning new content in order to have an exclusive element of the titles that are available through their platform. And all of these major players in the industry have done and continue to do just that, so that their services offer certain content you simply cannot obtain from anywhere else. But these major platforms continue to license a good proportion of their titles from existing large media players. So as I mentioned, this year and next, we're going to see the launch of a number of new entrants in the OTT market coming from what are referred to as direct-to-consumer services from major media companies. And there are 3 companies that have already announced their intentions, and those are Disney, Universal, and Warner Media. So in the final calendar quarter of this year and into the first half of next year, you'll see new services being introduced into the market. One of the things that at least one of those companies is doing is retaining its catalog of content as an exclusive feature of its own new streaming platform. And what we think will happen as a consequence of that is that it will create a good deal of disruption in the consumer market for OTT services, since large established media companies enter the market for the first time in delivering their own OTT services to consumers. What this all means for us, of course, is that there are going to be more players in providing OTT services. Those players, just like the existing ones, have that same requirement to process a significant volume of titles, including many new titles, by creating localized versions in many languages, because these services will be delivered globally, and on very quick turnaround. So this is undertaking that kind of effort, which of course has been in progress by established OTT players for some time, is a new requirement for these major media companies. So transitioning from being a media company into being a media company with their own OTT platform will inevitably bring some significant new requirements into their operations. I have a couple of charts here that come from some recent research produced in the US to give a feel for to give a sense of how the market may change. The chart on the left is indicating the number of hours of entertainment content that are available today for the US versions of some major OTT services, together with a number of smaller services that are available in the US market. And as you can see, the 3 biggest players in the North American market for streaming video on demand have, on average, over 40,000 hours of content available on their platforms. Much of that content, as I've said already, comes from titles that have been licensed from big media companies. In the chart on the right, what this research firm has done is to speculate how things may change in the future following the introduction of new streaming services from big media companies, where it's in this chart, they've assumed that each of those media companies will discontinue licensing their content to the existing OTT providers in order to differentiate their own platforms. And in that case, as you can see, that gives a marked change in the availability of programming across the different current platforms. And in particular, Disney, following its acquisition of Fox and a controlling interest in Hulu, which is the 3rd largest OTT service in the US, will be launched into the top position in terms of the amount of original program that they have available to them that could be retained as an exclusive feature of their platform. Again, what this paints a really interesting picture in terms of how this market is evolving, and for us points to significant opportunity if we are able to be successful in some of these RFP processes, to be chosen as a vendor, and ideally a primary vendor, for one or more of these major media organizations. I'd now like to just summarize our strategy and in particular to give an update on the progress on the 4 pillars of our strategic plan over the course of the last year. Firstly, as I mentioned, we're a technology-first player and innovation is in our DNA. We build cloud computing platforms that provide us with competitive advantage. Our platforms are technologies that we retain for our own use to provide us with a point of difference. So we do not monetize those platforms from licensing via SaaS or any other means to other players in the industry, but rather we retain them so that we can gain the competitive advantages that they bring. And those advantages are in the form of efficiencies through enabling shorter time to market, consistently high quality, and enabling us to price our services at competitive price points. I'd just like to highlight a couple of the innovations in the course of the year that I think are particularly significant. We've continued to invest in our platforms and enhance them, and in particular Zoo Dubs, which is our technology that enables us to perform dubbing services across all languages in a very capital efficient way. Has been enhanced through the capability to support lip sync dubbing. At the beginning of the year, we were offering primarily services around voiceover dubbing. By the end of the year, we had developed the capabilities in Zoo Dubs and developed our stuff internally in order that we're now able to offer lip sync dubbing, which is a more complex and demanding style of dubbing that is commonly used within the industry. The second major innovation I really want to highlight was a new technology that we're calling Zoo Studio. So as an organization that provides these services to our clients, we have internally systems that enable us to manage our operations across these different service lines. So we have already efficient tools in place within Zoo so that when we provide these services to our clients, we can manage a very large network of freelance workers located all around the world and engage with them effectively in order to scale our operations. One of the things that we have recognized is an opportunity to productize parts of that capability and to make that available as a solution that could be used by a large media company who is seeking to introduce their own over-the-top services. So on this next slide, Zoo Studio is essentially an ordering platform, but one that is purpose designed for dealing with all of the service lines that are necessary in order that a media company can prepare its content through engaging with vendors, external vendors, for release on their OTT platform. In the top right of this slide, there are a number of services listed there, and these are all of the service lines that need to be available in order to take an original program, say a new TV series, and do all that's necessary so that that TV series can be viewed on an OTC service all around the world. At the beginning of the year, there were 3 of these services that we were not fully able to deliver, and in the course of the year, we've developed new platforms and enhanced existing platforms, so we are now able to fulfill all those service line requirements. What that means is that we now fully qualify from being considered as a vendor and indeed potentially a primary vendor for large media organizations who want to work with companies such as ours in order to be able to scale up their production to create these materials needed for a worldwide release of a new OTT service. The key thing about Zoo Studio is that it will, if we were to provide it to one of our clients, it will enable that client's operations to operate in an incredibly efficient way and enable them to place work with multiple vendors. So namely with us, of course, but also with our competitors. Our intention is to monetize Zoo Studio in a way that will ultimately result in us having an advantageous position in terms of being able to secure a large proportion of the work that will be processed through orders placed by that client. So this, for us, is a mechanism, and it is unique in the industry as a proposition that could give us a strategic competitive advantage and align us closely with the needs of new entrants into the OTT market. The second of our 4 strategic pillars is around scale. And as I mentioned already, in our business, scalability for us is enabled through our cloud platforms, which are accessible to those we work with around the world. And a key part of the scalability for us comes from this large network of freelance workers. So our freelance workers are translators, they're voice actors, they're dubbing directors, sound mixing engineers. And these are all people who for us operate as a variable cost. We engage them on a project by project basis, all managed through our systems, so that we can keep our fixed costs in our organization at a low level. A couple of major developments then over the course of the year. The first is that this network of freelance workers, we've expanded by 50%. So we're now up to over 6,500 of these individuals. And I should be clear that these individuals are very carefully vetted and chosen. We now regularly receive an inflow of applications from, for example, translators and voice actors on a daily basis. And we vet these very carefully, and a small proportion, a minority of those applicants will ultimately be accepted by us as having the right capabilities in order to join our network. So this is something this network we've been building over the course of 8 years. It's now an incredibly valuable resource to us, and it gives us that flexibility to scale up and down our capacity in line with changing demands on our business according to orders we receive from our clients. We also made some steps to secure a stronger position in some key regions of the world that we see as being very significant in terms of forthcoming growth in OTT services. The first of which is an initiative we have pursued with a partner in Dubai to provide a local point of presence, which has enabled us to win a significant amount of business related to Arabic original content for that region. And we've also extended our relationship with a partner in Southeast Asia that has given us access to greater capacity to process work in a number of the local languages in the Southeast Asian region. The third element of our strategic plan concerns the way in which we collaborate with other operators within our industry in order to enable us to scale without requiring significant our own capital infrastructure. So rather than pursue a plan like our big competitors of either building or acquiring facilities in many countries around the world, we have chosen to partner with some key players in order to give us the necessary points of presence while retaining the inherent scalability and operational gearing within our business. And one of the activities that falls into this category is a research partnership that we've put in place with Sheffield University, actually, which has a specialist research group in speech technologies. And we're going to be working over a 3-year time frame on some research work that could yield features in our dubbing platform that could enable us to offer more productive work performed by voice actors. The first item on this list I just wanted to spend a little bit longer on. We've launched a new program that we call our Zoo-enabled Dubbing Studio program. And the reality is, for all the benefits that our platform and approach brings, which of course for dubbing enables us to engage with voice actors who are each located at a completely separate recording space. There are still instances where for our client there may be a need or some value undertaking the recordings in a traditional dubbing studio. So our Zoo-enabled Dubbing Studio program is an initiative that gives us that capability. So we've now have over 70 traditional dubbing studios signed up with us who have indicated that they will be prepared to collaborate with us on projects, which means that they will perform their work using our cloud software. And the way this program works is that a client of ours would place an order with us to, for example, take an original program and dub it into 15 languages. And some of those languages may require a physical dubbing studio, in which case, for those languages, we will outsource the work to one of our partners, one of our Zoo-enabled dubbing studios in territory, and that work will be done within our systems. What that means is that even though those projects are done the voices are captured in a slightly different way, it means all of the materials, all of the recorded soundtracks are contained and managed within our systems. And therefore, they benefit from the productivity gains that are possible through the automation that we built into those systems. So this essentially gives us a great deal of flexibility and scope in engaging in different ways with different clients according to their specific needs. The fourth and final element of our strategic plan is to do the way in which we engage with our clients. And I've already spoken to this point so far in this presentation. Most of these organizations have their own partner programs, as I've described. And so our intention is always to be chosen as a preferred partner when these organizations go through a procurement process to select the organizations they intend to work with in the period ahead. So we are already, for subtitling, a preferred partner for a number of major players within the industry. And we are, as I mentioned, going through at the moment a number of RFP processes with different organizations who are about to select the partners they want to work with for the period ahead. And whilst those processes are still underway and have not yet concluded, we're increasingly confident that we will be chosen as a result of those processes. Now I'll hand over to Phil.
Thank you, Stuart. Good afternoon, everybody. So I'm just going to give you a little bit of more detail around our March 19 year-end results. Starting with the profit and loss account. So revenues in the year, fairly flat. Three main reasons why the revenue growth we were expecting didn't occur. The first one was the drop-off in the DVD business, which was down 12%. And then the localization, which is our dubbing and subtitling business, didn't grow at the level we were expecting, partly due to some slippage of major projects from one of our major customers, and also through a change in their procurement process earlier in the year. Cost of sales, which in our business reflects both direct costs, i.e. the freelancers, but also our internal direct costs. So that's the project managers who deal directly with customers, the people who do the tech quality control. We built that team up in the year to meet the expected demand, which unfortunately slipped into this year. So our costs, particularly on the staff side, were up 3 percentage points. And so had a hit of about 700,000 in terms of our gross profit. So came in at 32%. We were anticipating it being nearer 35%, which was the number achieved in the previous year. As Stuart has taken you through already, there's been a lot of investment in our business this year. And we've made some great strides in terms of the RFPs that we're working on and in terms of the R&D. And that was reflected in our operating expenses. So to make ourselves look bigger in the market, to compete with our competitors, we doubled our marketing spend. We brought on a couple of more salespeople. And we did spend an extra 60% on R&D, of which only a proportionate was capitalized in the year. So the impact of that upfront investment in the business was that without that revenue growth, our EBITDA came in at 0.4 versus 2.4 in the prior year. And we took a conscious decision to keep that expenditure in the business because we felt that it would put us in a very strong position when we start to go into the new year. And I suppose the positive is that to grow the revenues to the numbers that are in the market at the moment, we don't really need to spend any more on OPEX, and we don't really need to spend very much more on our own direct staffs. So the only change will be the variable costs as we go forward. Thanks to our convertible loan notes and the accounting need to revalue the embedded derivative that goes with it, we end up making a full year profit. So compared to a $5 million loss. So obviously it's an accounting entry. It's not real money. It's not real profit. But the headline figure that you can see is we made a profit of 1.6 million. Moving on to the balance sheet. And I think the key message I'd like to get across here is that the company's actually in a very strong position from a cash point of view going forward with the expected revenue growth in the year. And what you can see there is that in the non-current assets, which is effectively our capitalization of R&D and our purchase of fixed assets, very little change in the year, 7.9 to 8.1. So effectively what we're saying is we're investing roughly the same amounts as we have in the past. We're not going crazy and investing lots of money in the business at this stage. Trade receivables up 9%. That reflects the very strong Q4 in terms of our revenues. Very strong revenues from our subtitling customers in particular. And I can confirm that virtually all that money's been received in Q1. Looking on the payables side, 17% increase in our payables. The key component of payables is our freelancers and the agencies we work with. And that's actually a lead indicator of future business because we tend to pay our freelancers before we finish the projects and before we're able to recognize the revenue. So it sort of gives you an indication that we're having a very strong Q1. And then the non-current liabilities, which have fallen dramatically in the year, and I wish that was a repayment of real debt, but it's not. That's the other side of the entry in terms of the embedded derivatives. So the valuation of the embedded derivative has gone down by roughly 2.8 million in the year, and that's reflected in there. So the only real non-current liability that's in there is the actual loan notes themselves, which have a value of £2.6 million, and the maturity date is October 2020, and the conversion rate price is 48p. So we're pretty confident that at that point in time, the holders of those loan notes will convert, and that debt will then just disappear, and we'll stop paying 300,000 a year in interest payments.
What's the interest rate on that?
7.5%. Yeah. The other way that we look at the business and we report the business is by segment, and we have three key segments: the localization, which I'm sure everybody knows is the subtitling and the dubbing. The second area is the digital packaging, which is the DVD work, but it's also the conforming work that we do for the streaming services as well. And then the third one is those legacy software solutions, i.e. software that we have sold in the past to the likes of Disney and Paramount, which are fairly flat but very high margin. And what you can see there from a gross profit point of view, that localization is down 3 percentage points. That's a function of the mix. We had more dubbing in the current year than the year before, but also the fact that investment in people. So what I would expect going forward is that margin erosion of 3%, as the volumes go up, will be recovered, and we're back to a more normalized 35%. Digital packaging also down slightly, but again, that's because we were carrying people in our organization who are there ready to deliver the volumes as they come through, and they're coming through as we speak. And software solutions is roughly the same profit margin year on year. No real cost involved in that business for us. So overall, our margin's down 3 percentage points from 35 to 32, but the bulk of that is to do with us carrying people who we know we need for the future growth of the business. And then finally, really, our key performance indicators. I've explained some of these already, but worth mentioning one or two of them again. Obviously, top-line growth is a key indicator for us. And besides those slippage issues I mentioned, it's also fair to mention that we did have a very large one-off order in 2018, over $2.5 million, and we didn't repeat any business with that client in this year. So it was a sort of a target that was quite difficult to beat. That's nothing to do with us. It's just that particular client didn't actually license any major content to one of the streaming services, and therefore there was no need for them to have localization services. Our performance was excellent, and if they do a deal in the coming year, I'm pretty certain they'll come and ask us to do the localization work for that. And that also affects what we call the retained sales. If you take that one order out, the 2.5 million, then our year-on-year comparison is exactly the same, 97%. And Operating expenses has grown 37%, up from 33%. Again, that's because we invested in those salespeople, we invested in the marketing, and we invested in the R&D, a conscious decision made by the business. And then finally, the only one I haven't mentioned, but Stuart definitely did mention, is this 50% growth in our freelancer base, up to 6,000 people. So again, hopefully the message you're getting here is, financially it wasn't a great year, but we've put the capacity in to be able to meet the demand in this coming year, and you'll start to see a much better set of financial results in the year to March 20.
So our investment premise then, in summary, is that we have a technology-first approach that to this area of media localization that gives us significant competitive advantage in the market. We are unlike any other player in this industry because of that. With that technology, we're able to offer an incredibly scalable service, and that scalability comes in part through engaging with this large pool of freelancers, all of whom are carefully vetted and we know are able to deliver work of the required standard, and that enables us to flex our production according to the inherent capacity within that freelancer network. This is a growth market. We believe that the media localization globally accounts for a roughly approaching $4 billion spend across the industry, and is growing according to recent research. And given the particular changes that are about to occur within the industry through the launch of these direct-to-consumer services, we think those will give rise to further growth in the kind of services that we provide. As a business, we've been in this industry for some considerable time now. We committed to a focus on home entertainment in 2006, when it was all about DVDs, and now we're a leading player in this new OTT market revolution. We're technologists at heart. All of the board and senior management have significant experience in the software industry. And we have a long track record of working with major media companies throughout our history. The outlook then, this market opportunity, as I've said, continues to grow and offer new potential clients or new lines of business as a result of these new direct-to-consumer services. We announced very recently that our non-executive chairman, Roger Jeans, who's been with us for 9 years, would stand down in line with good corporate governance, and we've just announced Gillian Wilmot will be taking over as chairman from the 1st of July. We're very pleased to have her as part of the team. As Phil mentioned, we have begun the new year with a strong performance, and in particular, I'd just like to highlight what we see happening within our digital packaging segment. As Phil touched upon, there are two parts to that segment. One relates to the old formats, DVD and Blu-ray, and the other relates to these new OTT services. And in our year to date, we're seeing strong growth on the OTT side, which is offsetting the significant decline that we've observed and continue to see on DVD and Blu-ray. The investment that we've made and Phil has talked you through in R&D, in staffing, in training, will enable us to pursue the next phase of our growth without requiring any significant additional expenditure in the area of fixed costs. And of these RFPs that are ongoing, we're confident that at least one of them will be very favorable for us. There is a possibility that we may be chosen with multiple media companies, and just one of those contracts could make a substantial positive difference in the financial performance of this business. So consequently, we're very confident. We think we're very well placed to capitalize on the opportunity that exists now, is emerging, and is set to continue to grow for the foreseeable future.
Stuart, could I ask, you mentioned the provision of Zoo Studio potentially to a large studio. That's not being monetized in any formal way other than some kind of informal arrangement or agreement or a handshake, which means that you'll get a certain proportion of the available business as one of the preferred partners. Is that right?
So in our response to these RFPs, as well as in our dialogue with other potential clients and existing clients who are not going through an RFP at the moment, is that we can uniquely offer this Zeus Studio capability. From our perspective, we see the greatest value that we could obtain out of that would be to gain some surety over revenue sources from these lines of business that we operate, these service lines, and in particular, visibility of revenues for a significant forward-looking period. So our focus, the way in which we will construct those deals will be in order to maximize the benefit to Zoo. And exactly the shape of those things, I think, is still to be seen. But that's what's important to us.
And another quick question from me. I know that in the past we haven't broken out the split between dubbing and titling. Might that come at some point in the future? And a corollary to that is, although you can't give us any numbers, can you give us any encouragement that the proportion between dubbing as a whole of localization is moving in the right direction?
What I can say about dubbing is that if you refer back to that chart that I showed about the progression from different phases in terms of a relationship with these large buyers, in dubbing we are, in subtitling we're eight years down the line, and therefore we're established, we're proven. It's without question that we can produce work of the highest quality in the industry at scale across all languages, and consequently we've benefited from being chosen as a preferred vendor of those service lines. But for dubbing, we're at a much earlier stage. We're only 2 years down the line, and it takes a little bit of time. So the best we could hope for really at the moment is to be to persuade big media companies to work with us on some initial projects for dubbing. And what we can say is that, compared with the prior period, we've doubled the number of major studios who have been putting work to us to provide dubbing services. And of course, we've done a great job, and they've been very pleased with those, and that then bodes well for us being able to win further business going forward.
In the actual prelims announcement, we actually state that dubbing grew by 17%. And if the overall localization grew by 4%,
subtitling fell by quite a lot.
well, not really, because it's such a much bigger number. It was basically flat, actually. But there you go. Yeah.
In terms of the group's cash position, you've got sort of 1.8 million at the end of the year. And then your cost of sales and operating expenses is about 30 million. Mm-hmm. Do you have enough cash?
Yes. So we are cash positive. In the second half of the year, we were cash positive by $1 million, because we only had 0.9 roughly at the half year. So we were cash positive in the second half of the year. Our forecasts also predict that we'll be cash positive in the year coming. And in addition to that 1.8 million of cash that we can use, we have debt facilities of 2.5 million, which were unused at the year end. So we're confident that with the numbers that are in the market for the next 12 months, we've got more than sufficient cash.
Thank you.
Are you a preferred supplier yet with any major studio in dubbing?
Not yet. Dubbing, you have to be mindful of the fact that this is a very conservative industry, and it took us a while with subtitling to be able to move from that phase of being an ad hoc supplier into being essentially a regular supplier through it being chosen as a preferred vendor. So we are only 2 years into a process with dubbing, and of course dubbing is rightly seen as being a much more creative undertaking. It's a much more complex process, involves lots more people, there's much more subjectivity around it, and therefore inevitably we think It will take time for us to gradually demonstrate that we can deliver. First of all, we can deliver work of at least an equivalent standard to anyone else in the industry, but also that we can do that at scale and we can do it across all languages. So these are things that will just take a little bit of time. And as I stand here today, we are not currently in that category of an approved vendor for dubbing. But we believe that that is a situation that may well change in the period ahead as we, in relation to some of these RFPs that are ongoing at the moment.
One last question on digital packaging. You said some new product is replacing the old product, the loss of sales from the old product. Is that going to mean that there's no drop in digital packaging this next year?
It'll go up.
Right. Okay.
And I don't fully understand the embedded derivative, but given that all the profit plus some is a result of the revaluation of the embedded derivative, how is that going to play out?
So again, at the end of this current year, we'll have to revalue the loan notes. So it works a bit like a share option. The shareholders, by allowing this convertible loan note to sit there with a conversion price of 48, and let's say the share price is £2, you're actually giving a lot of value away to those loan note holders. And new accounting standards insist that you actually work out what that value you're giving away is and put it through the P&L. A bit like you do with share options. If someone's got a share option.
It's a result of the fall in the share price?
So the result of the share price has meant that in the year that valuation has gone down, and then therefore you write it back in through the P&L and you reduce the liability that sits in the balance sheet. That's why it's all
This doesn't sound good though if the share price recovers.
Well, so just for those who don't follow our share price quite as much as I do, at the end of March 18, the share price was 95p, and at the end of March 19, the share price was 53p, and that's basically what the calculation they're making. It was still above 48, therefore there was some value in the loan note.
So if the share price goes up,
Yeah.
unfortunately,
You'll have to write down.
Yes, so the better we do, the higher the loss will be. However, when the loan notes mature, which is only a year away, October 20, we do a final valuation and that goes through reserves and the thing gets lost forever. But the one thing that a few people asked me last time we were on the roadshow is, wow, how are you going to find $8 million? I said, no. that will never be a cash payment, don't you worry.
Can I just ask you a little bit about your market position? I mean, what percentage of your revenues come from either UK or US domiciled clients? And maybe, just a little bit about how the market is changing, given that there's an explosion of content and that people are starting to take content to the African nations and. Just a little bit more about your market share, your positioning, how you can take yourself into some of the newer territories, who your competitors. Is there another listed competitor in this space anywhere?
Right. Okay. We're obviously a UK headquartered and quoted business, but actually more of our staff are based on the west coast of the US than they are in the UK. And our largest clients are all US domiciled organizations, major film studios and OTT services. So consequently, more than 90% of our sales in the year was in US dollars to US-based organisations.
It's actually in the prelims. No, I wouldn't expect you to. 25.4 million out of the 28.8 million was sold to customers in the US.
You mentioned that there were 3 services that weren't available at the beginning of the year.
Yes.
That are now available at the end of the year. Which 3 services were they?
So at the beginning of the year, we were doing voice-over dubbing, and by the end of it, we're also offering lip-sync dubbing. So lip-sync dubbing is one of them. Audio description is a service that to provide essentially voices for the benefit of those who are sight impaired, basically. So this is usually a descriptive speaker who's explaining some action that's on screen for those who are who can't see the picture very well. So that's and we deliver that service using ZooDub. So it's an additional capability we built into that platform. In the year, we also actually developed and deployed a new platform called ZooScripts, which enables us to essentially prepare the original language script for a project. And often we use that as sort of like a precursor to then in turn going off to produce the subtitling and the dubbing. So it becomes sort of a way to create some standard reference materials that then benefit the downstream subtitling and dubbing processes. But an output capability from our scripting platform is that we can create what are referred to usually as recorded scripts of the original program. So when a new program is created, the producer of that program will normally need to keep a record of exactly what has been said on the program for reasons of IP protection and legal clearances and one or two other things as well. So they will normally commission the scripting services to prepare those materials, and we're now able to do that. Richard?
With the projects that you're getting at the moment, Stuart, you say that some clients are requiring them to be split. So you've got some doing the higher margin ZooDubs thing that you're offering, and some of the parts of that project are having to be done via the traditional studio. Can you give us an idea over the last few months what the split is with typical projects that have to go through partly traditional and partly home, effectively?
Just to clarify something, just to make sure I've been really clear about it. From the perspective of our systems and our internal processes to initiate a project, to capture the voices, to end up producing a mixed and quality controlled soundtrack for that new language. When we go through that process, whether we use a traditional studio or whether we have someone working in an acoustically treated space, is completely transparent. There's no difference. To our process, how the voice is actually captured is exactly the same. It's essentially a voice actor speaking into a microphone with their voice, the sound being captured within our systems. So it's not that we're just sort of doing it, it's not that we're kind of not using our platform in that setting. We are using our platform, it's just that it's in a more formal setting in which, for example, our client might want to come and observe recordings as they're taking place. So if it were a particularly high value title, where, and perhaps therefore a famous actor in that target language is being engaged to do the work, then it would be usual to do that in a sort of a traditional dubbing studio setting. So what we're saying is that by launching our Zoo-enabled Dubbing Studios program, we're able to offer that as an option to a client that requires it. In answer to your question about the split, I actually don't know that. I don't know the answer to that question off the top of my head. But what I would say is that there is a mix in its evolving picture, and to some extent, it is exactly how it's operating at the moment. Maybe more a function of wanting the client wanting a comfort blanket, more so than actually any genuine issues about the ability to capture professional quality voices in an environment that isn't a traditional dubbing studio.
Yeah, it's worth mentioning that when a client says they want that, we increase the price. So there's no financial impact to us. We basically work off a set margin because we know what the cost is, and therefore we'll just mark it up to that. So if they say, yes, you've got to use a Paris studio, it's fine. We're still going to make 30-odd% margin on it.
Last year, you badly affected by a customer pulling a big order. Has anything changed the way you plan your forecasts and the way you accept work so that that can't happen going forward, or is it less likely to happen? Has anything changed?
We basically, in our revised forecast, which I'm sure you're aware are slightly lower than they were before, we have downgraded our expectations from that client. So we're basically saying we've got a run rate from them, let's stick that in the forecast. And if they place some big orders on top of that, that's a nice, one-off for us. But we're not going to be sitting there chasing it. And to some extent, last year's forecast, we were obviously chasing all the way through the year. So we're taking a much more prudent view.
Stuart, Phil, thanks very much indeed.